Hey, it's Jeff Garber, mortgage expert, mortgage interest rate guru. Today is Wednesday, May 4th, 2022. It is Fed Day. This is the second video that I'm making, interest rate update for this week, because it's that important of a day. And I want to break down to you what happened here. All good news for mortgage rates if it holds. So let me get myself out of the way and we will start. So what you're looking at is the bond market, more specifically mortgages that trade in the bond market Monday through Friday. And these mortgages are called mortgage bonds or mortgage-backed securities. You may have heard the term in the news or have read about it. And bonds, basically, as bonds go down in price, like they've been doing for the most part since the beginning of the year, rate goes up. So there's an opposite reaction. Bonds go down, rates go up, right? In English, if we have green days, that's a good day. Red is a bad day. So we're always looking for green days because green means that bond prices are rising, and when bond prices rise, yield or rate falls. So what happened? Well, the Federal Reserve raised what they call short-term overnight rates by 50%, 50 basis points, a half a point, not 50%. They raised rates 50 basis points or a half a point. And what does that mean? Well, that means anybody who has a line of credit, home equity line of credit, or any variable loan, adjustable rate loan that's tied to prime rate, that means that those rates are going up. Credit cards, some credit cards are variable. Car loans that are coming up, new car loans that you might get, those rates could go up. That's what the Fed controls, overnight lending rate, not long-term 30-year fixed mortgage rates. And oftentimes, when the Fed is in a cycle where they're raising short-term rates, they're doing so because they want to slow the economy down and improve inflation. They want inflation to become lower. So the way to do that is to gradually raise short-term rates, slow down consumer spending, and therefore inflation will come down. And when inflation comes down, so do mortgage rates. Well, bond market liked that announcement today, and more specifically, it liked some of the press conference words that the Fed Chair Jerome Powell had said. One of them being adapting. They've used the word adapt to the markets, which they have not used before, and the markets are liking that. Well, what does it mean? It means the Fed's going to be keeping an eye out on the economy, and they're going to adapt and make their policy based off of what's going on. Meaning they're not going to be, quote unquote, stubborn and stick to a policy that they said they were going to stick to regardless of what's happening. In other words, they realize inflation is too high right now. They want to get ahead of it, even though it was their fault that it got this high. They do want to get ahead of it. And if they can convince the markets that that's what they want to do, then the markets are going to react favorably. And so far, that's what you're seeing. We had a big jump up, a big green candlestick after the Fed announcement. And that's good. If this can continue and we can continue to see an upward trend in bond pricing, then mortgage rates will come down. So what does that mean? Well, we got to watch. Oftentimes we see big movements on big days like this. Sometimes they're head fakes or knee-jerk reactions, we like to call them, and sometimes they're for real. So what are we going to do? Well, we're going to, go to sleep. We're going to sleep on it. The markets are going to sleep on it. We're going to see how the markets open up tomorrow and what happens over the next couple days. And that'll really determine if there's a possibility that maybe, rates can stabilize or come down a bit and give us all a little breather so that, we can stop worrying every day that rates are going up and away. And maybe they'll flatten out here and maybe come down and keep everybody happy here. So I will be back at you next week to break it down even further. And if you have any questions, you can leave comments below. And look forward to catching up with you next week.